G'day everyone, welcome to the weekend general update for the 21st of July. And we've had another strong week on global markets and certainly a very good week for a lot of the small cap stocks that we've been trading in Australia. In fact, probably just about the best week of the year so far. So let's have a look at the action and see where to for the next few weeks. And I think the key thing here is that whilst the S&P index continues to rise, as we'll see from the chart, it's really getting pretty overbought, and I think we've got to be close to some sort of pause or a bit of a retracement in the market just to get rid of some of this excess. So the S&P ended up rising 12 on the week, and it was the fourth weekly rise in succession. Reached another all-time closing high, so it's all positive. And as I've been saying now for many months, even more encouraging is the fact that the small and mid cap Russell 2000 index is even stronger. So that's telling me that there's no real lessening of this market momentum. This is not just about funds buying the biggest stocks in America, and that's what's causing the index to go up. This is very broad-based buying right across the whole market, and the small and mid caps, if anything, are stronger. So that's a very positive sign for the market. However, the deviation to the mean or the moving average is now as pretty much as high as it ever typically gets. Now, it doesn't mean it can't push a little bit further, but it really is extended a long way now, and one thing that you learn about markets if you've been around them for a while is that ultimately all things return to the mean, and that provides us with our best buying opportunities. Now, there's also a very typical pattern. It doesn't always occur, but it happens a great deal of the time, and that is that US markets rally into the earnings season, which started about 2 weeks ago. That earnings season runs for about 6 weeks, and typically in the back half of that earnings season the market will sell off. So that's why I think in the next week, maybe 2 weeks at the most, we are going to see some sort of pullback in the US market, and that'll create a good opportunity for us. So let's have a look at the S&P. If you can see the run here that started at the low in November of 2012, it's been a terrific run. We've had a bigger correction here in June, and that was really with the suggestion from Bernanke that he was going to start tapering back QE3 more quickly. The markets took that pretty badly, but look, it sold off to exactly the level that you would expect it to. You know, I've read a lot of commentators this year have said markets are tough, but I just don't see it that way. I think markets have been incredibly predictable this year if you know what to look for. So we pulled back almost exactly to the level. 1556 was the level I was looking for, which is a technical level that was pretty obvious. It got to 1560 and then turned around and has gone back up and now at new all-time highs. Now the thing to look at here is how far above this red moving average line the price gets, or the index gets. So we saw here in late May, it got a long way above, and then we got this sharp turnaround and down she came, almost to the back to the mean again. But there's so much buying momentum in America that it didn't quite get there and took off again. And I think we're going to see the same sort of thing. This might keep pushing up for another week or two, but it's on borrowed time in my view. So that has some implications for our strategy. Now, turning to the Australian market, our index did nothing on the week, but as you've heard me say before, I don't tend to follow our index very much because it's just a reflection of about 8 or so major stocks, and so it doesn't really tell you very much about the stocks that we're typically trading in. So the rotation from the safer yield stocks, the banks and Telstra and Wesfarmers and those sort of stocks, coming back into growth stocks and also into resources, well, that continued last week as well. We saw some further improvement, and certainly BHP and Rio outperformed the banks on the week. Now, there are still several potential negative triggers out there to do with China, to do with every time Bernanke opens his mouth, to do with Europe. There are certainly some things that could upset the Australian market. Probably China is the most. So we need to stay focused on buying the dips, and buying the dips in the best financial performers this year has proven to be a really winning strategy. So let's just take a quick look at the Australian index just for the sake of it. That's the ASX 200. So we had a really good run the week before, but essentially flat on the week, and you can see well below the May highs as opposed to America, which is back above the highs that it set in May. Now, the other chart that I want to look at is the Russell 2000. So you can see it's also just going massively well. It's outperforming the S&P 500, but you can see there's also a significant deviation to the mean, and the RSI is overbought. So I don't expect this is going to continue for too much longer. Now, looking at gold, gold rose a little bit on the week. It was up $11, but the GDX basing pattern continues. We saw some better performance from some of our best gold producers in Australia. So that's all looking fairly positive. And I read recently that the physical buying of gold, so this is not the paper market, this is not the futures market. Now, over the recent decade, it's been the futures market that sets the price for gold. So therefore, the gold price can be physically manipulated to be whatever people want it to be. The biggest players that have got vested interests in this can basically push the price of gold around by buying and selling futures contracts, which are effectively just created out of thin air. They're not backed by anything. And the amount of gold which is traded through the futures market is many, many times greater than the actual physical supply of gold, at least an order of 10 times. I'm not sure that I've actually seen an accurate figure, but it is many, many times. And so therefore, the futures market is a manipulated, contrived market, and that is what's setting the price of gold. But when you look at the actual buying of physical metal, so this is gold actually being delivered, then what is going into China at the moment is at unprecedented levels and is equivalent to buying all of the global mine production. So China is effectively right at this minute, if it were to continue, they'd be buying up effectively all of the global mine production. Now that's obviously an unsustainable situation, so it's going to be very interesting to see what happens to gold over the next 6 months or so, because I feel something's got to break in this incredible conflict between the fact that the futures market is holding the price of gold way down at a time when the buying of physical gold into China is just at extreme levels and exceeds all capacity of the system to supply it. So it's going to be very interesting to see how that plays out. Copper was steady at $3.13 for the week, didn't do much, but look, the big move has been oil. This has largely been triggered by what's going on in Europe, and oil jumped up further to $108. So it was only just a few short weeks ago that oil was trading around 92, 93. So let's have a look at gold now. So this is gold on a weekly chart. So you can see didn't really do very much last week. I'm not sure whether it's bottomed or not. I've got a feeling we might just see one last little leg to the downside, but that doesn't mean that we're going to see gold stocks necessarily roll over big time again, because as I've said before, many occasions you'll see gold stocks move anywhere from 3 to 6 weeks before the physical price of gold bottoms. So that's gold on the week. If we have a look at the GDX index, you can see it's still continuing to basically form a base here. But what I do like about this is all of the positive days are accompanied by significant spikes in volume. So all these blue volume spikes, they're all the up days. So there's a lot more volume coming into the gold stocks and into this. This is effectively an exchange traded fund. So the heavy buying is on the up days. Now, if we take a look at the at the spread that we've been looking at, this division between the GDX index and the price of gold, we've been looking at this all year. You can see it's been significantly in downtrend, which means that the price of gold stocks has been underperforming the price of gold significantly. Now, it's still only just in a basing pattern, but we're now back to seeing regular occasions where this ratio is starting to come back up above the moving average. So it all adds to me that over the next 3 to 6 months, we're quite likely seeing the bottom in gold stocks, and then that will be followed shortly after by an actual low in the price of gold itself. So certainly some better signs, and some of our better gold producers are looking a little bit better. There's the copper chart on a 6-month basis. Not much movement there. So from an overall strategic point of view, I feel the US market has to take a breather soon. That will shift sentiment negative for a few weeks. There's no question that quite a lot of stocks on the Australian market will go down a bit. So I see that as a major buying opportunity, because I expect the second half of this year to be a strong one, given what's happening in America, and it's just really a matter of getting good entries in what will be a pretty positive finish to the year. The very best financial performers have made excellent gains this year, but only if you buy on the dips. So that's the important part, and that's really where discipline is absolutely vital in what you're doing. I also think this is a time for taking some money off the table, because there's two parts to the process of buying the dips, and the first one is that you need to create some cash before the correction comes, so that you are partially cashed up before the correction, and you can buy then the right stocks on the dips, and that's what we've been doing all this year, and that's why the results have been as good as they are. So that's it for this week. It's going to be an interesting couple of weeks. As I said, I expect to see a bit of a correction in the US shortly, and that'll be a great opportunity for us. That's it for this week. Cheers.